The S&P 500 fell, big tech slipped, portfolios across the board took hits. But there's something most investors missed. 5 companies that didn't just survive the chaos, they surged ahead. While everyone was watching headlines and tariffs, panicking, these 5 stocks kept climbing. No hype, no social media buzz, just pure, resilient performance. Today, I'm breaking down 5 tariff-proof stocks that outperformed during one of the toughest stretches in recent market history. And they could just be getting started. The S&P 500 peaked in February and then dropped over 21% through March and April. It wasn't just a correction, it was a wake-up call. Poorly constructed portfolios got wrecked, confidence further shattered. But here's what makes this moment so interesting. While most stocks crashed, a few quietly kept climbing. And those are the 5 I'm about to show you. Since the April low, the market has bounced back up over 30%, but it's still trading below its February all-time high. And that tells us 2 things. 1, volatility is back, but 2, only the strongest businesses are keeping their trends intact. And if you know where to look, some stocks didn't just hold up, they actually rose. Okay, let's start with one of the most iconic companies in the world and why it quietly beat the S&P 500 while others fell apart. The company in question is Coca-Cola, one of the most globally recognized consumer brands, currently worth over $312 billion. It's solidly in the top 40 most valuable companies in the world. Here's what might surprise you. While the S&P 500 dropped over 21% at its worst, Coca-Cola actually gained, up around 12% since February. And if we go back to early 2020, it's up nearly 100%. For a consumer staple stock, that's pretty impressive. Over the past few years, Coca-Cola has reinvented itself. They've cut sugar, acquired health-conscious brands, and invested heavily in sustainability. It's stayed culturally relevant and financially resilient. It's no accident Buffett's held onto it for decades. It's a cornerstone in Berkshire Hathaway's portfolio because it delivers. No, it's not a hype growth story, but if you want consistency and strength, Coca-Cola is a proven anchor. But Coca-Cola isn't even the most profitable Buffett-backed stock on this list. In fact, one company he owns has done what few expected. It's actually outperforming him. Let's talk about it. This is Warren Buffett's empire. With a market cap of $1.15 trillion, Berkshire Hathaway is now the 8th most valuable company in the world. But it's not just a company, it's a fortress. Inside are railroads, insurance, energy, and huge stakes in firms like Apple and Bank of America. Here's what really matters. Since early 2020, Berkshire Hathaway stock has climbed over 230%. That's nearly 2.5 times your money. And when the index dropped, Berkshire Hathaway rose, up around 10% since February. Now that's not luck, it's strategy. Berkshire Hathaway doesn't chase trends, it compounds value. Buffett is famously sitting on over $150 billion in cash, but that cash isn't idle. He's collecting billions in interest from short-term T-bills while he waits for the right opportunity. But here's where many investors get it wrong. Trying to mimic his move and stay in cash will absolutely backfire on you. What's worked? Owning Berkshire Hathaway itself. If you want broad exposure to corporate America without really stock picking, Berkshire Hathaway is your long-term play. All right, so we've talked about icons. Now let's talk about the company that might just be running a third of American healthcare. And most people have never even heard of it. Let's talk about a name that rarely makes headlines. McKesson Corporation. Market cap roughly $86 billion, but its footprint is huge. It's one of the largest pharmaceutical distributors in North America, touching 1/3 of all prescriptions filled in the US. Since February, McKesson is up around 11%. Since early 2020, it's climbed more than 515%. That's not just performance, that's life-changing growth if you had invested in this company. I first shed a light on McKesson back in late 2021 across my socials. Since then, it's up more than 180%. And in 2022 alone, it surged 65%, while the S&P dropped nearly 30%. This isn't a headline chaser. McKesson has modernized its supply chain, leaned into specialty pharma, and optimized its operations. It's not flashy, but it is very efficient. And that's exactly what makes it dangerous, in a very good way. The next company, even smaller than McKesson, but with a business model that could reshape modern medicine. Senora, formerly AmerisourceBergen, might be McKesson's little sibling, but it's moving like a market leader. Market cap just under $55 billion. Since February, it's up around 14%. And since 2020, a rally of over 290%. They're not just distributing drugs anymore. They're building a healthcare infrastructure engine, one acquisition and innovation at a time. Their recent rebrand signals a broader mission. Acquisitions like Retina Consultants of America show where they are headed, towards high growth, high need sectors of medicine. It's early innings, but if you're looking for something that combines stability with expansion potential, Senora is your dark horse. Next up is a controversial company criticized for its history of misleading consumers, but has quietly delivered massive gains. It's Philip Morris, a tobacco company, but one undergoing one of the most radical reinventions on the market. Current market cap, over $260 billion, in the top 40 of global rankings. But here's what some may be missing. They're pivoting hard towards a smoke-free future. Their IQOS device is already dominating in multiple international markets, and soon more than 50% of their revenue will come from non-combustible products. The market is no doubt paying attention. PM's stock has jumped over 200% since early 2020 and almost 20% since setting record highs in February, while the index, of course, is still well below its own all-time high. And that's even before factoring in dividends. But here's the thing, knowing what to buy is only half the battle. If you don't follow the right system for how to invest, you could still lose. Just like many who blindly follow Warren Buffett's strategies today. That's why it's critical that you watch my next video, breaking down Buffett's system and why, for most investors, it actually loses them money. In that video, I'll show you the exact strategy we use instead, the one that's helped us average over 30% per year, and how you can apply it yourself.